We're going to be talking about administrative and programmatic standards. So these are going to be the standards that are in 2 CFR 200. And then we have very specific standards that are in our program guidance, which is in the 23 CFR, 49 CFR. And so we'll be talking about the linkages between those different program and administrative requirements. So we're going to be talking about, and hopefully everybody will be able to understand the requirements for ensuring financial integrity. So this is where yesterday, remember, we talked in 23 U.S.C. 106 that Federal Highway has a responsibility to ensure states have good financial systems and project delivery systems, and states, you have the responsibility for ensuring your locals have that, your subrecipients. So we'll talk about where you can find what does it mean to have a good financial management system. Then we're going to talk about the various matching provisions. So we'll talk about all the different things that can change your match, because our standard match is 80-20, but there's a lot of different things that can change that. And some of our programs have a higher match, so we'll talk about those. Then what are the provisions for real property and equipment? So if we're going to use federal dollars to procure real property like right-of-way and equipment, what are the rules that you have to follow? Then identify the different methods of procurement. So remember, that's one of our exceptions to the rule. Same with equipment, where the states, you get to choose or use your regular state procedures for procurement and for equipment, but there's an exception in 1201 of 2 CFR that says that you also make those decisions for what your subrecipients are going to use. So we'll talk about the procurement methods. Then explain the importance of monitoring again. So we're going to talk about monitoring again. And the reason why we talk about monitoring so much is because you should have continuous monitoring throughout the program and throughout the project life cycle. So back to 23 U.S.C. 106G. This is where it says that Federal Highway is responsible for ensuring that we have effective and efficient use of federal dollars, and how we do this is we have to make sure that states have good financial systems. So your financial systems can handle the program, it's project-based, you can track your time by project, that kind of thing. You have a good methodology for estimating project costs. So remember, we talked several times yesterday about best cost estimate. You have to have those methods to do your estimates for, say, construction or contracts, and are those estimates pretty close to what you're actually getting in bids? And if you're seeing big variances from what you're coming up with on an estimate and what your contractors are bidding, then you might want to go back and relook at what your methods are. And then finally, project delivery systems. So we have to look at financial systems and project delivery systems kind of together, because a lot of things that happen, and it really depends on the state system, you could actually put accounting or financial data or like fund codes in the project side, and then as things are billed, they might roll over to the finance side and might lose some of that detail, or it might retain that detail. So we have to kind of understand how it works. Now states, you have to do the same thing for your locals. You have to make sure that they have these same good financial systems. So in 2 CFR 200, this is in subpart D, so these are the post-award requirements, which basically means after the award, these are the things that we need to make sure that are in place. So what 2 CFR 200 says is we follow state laws and procedures. So you, the state, you follow your regular procedures that you would use for your non-federal projects. You would have to do the same thing on your federal projects. So there has to be consistency between the programs. Your systems have to be able to prepare reports. Your system has to be able to track that record retention. So when the project is done or we have the final voucher, now we're going to track how long we have to keep those records. You have to be able to track your funds to an expenditure level. So what that means is if you have somebody working on a project, we should be able to go all the way down to that time card and see that that employee worked on this project for this amount of time. We should be able to drill down and identify what their pay rate is, plus any fringe benefits that you might apply. So we have to be able to track all the way down to that transaction level. Then you have to be able to track all of your expenditures and your obligations and all of your awards in your system. So you can see up there, it has to be able to look at unobligated balances, what you have not expended yet, what your expenditures are, and all of those should be tracked by that CFDA number, or it's coming up going to be changed to the federal assistance listing, and you have to be able to track at those numbers, at that listing number, because when you do your reporting and when you do your single audits, you're supposed to be tracking, and we're going to be doing audits on each one of those individual programs. And once again, written procedures. You should have written documentation, written procedures on how your payments work and how your obligations work. Then, for cost allowability, your system has to be able to identify certain costs and say, okay, this is an indirect cost versus a direct cost. And you should also be able to split your direct costs up by direct salaries and wages and other direct costs. So this is some of the questions, and on my team, on the Resource Center team, we have an individual, his name is Andrew Callahan. He's kind of our systems expert, and he goes out and does system reviews on state DOT systems, and he's primarily works on new system implementation, but he'll go out and he can also do a review on an existing system, and these are some of the questions, just some examples of questions. We have quite a few more different things that we talk about when we're doing the reviews, but I put these kind of the most common ones up here. So some of the things that you want to ask, and this could be related to federal highway looking at a state system, but these could also be questions that you might ask of a local public agency if you're reviewing their system. So is there a link between the state and local financial and project systems? That doesn't happen very often, but there could possibly be some states out there where maybe an MPO could push information electronically to the state DOT, and you guys could incorporate that into your system when you're building your projects. Kind of like how the states, most of the states or a lot of the states can do an EDS to FEMAS. So that would be similar, but we don't see that very much. But why do we ask that question? Because double entry is a risky thing. You could possibly, whatever you enter in the local system, you want to make sure that's exactly entered in the state system, and then, of course, exactly entered into FEMA, so we have consistency. But if you're doing double entry, there's a possibility of, making an error. Then, does the entity have all phases on one federal project or a separate federal project for each phase? That's why I asked that question yesterday, and we heard in Oklahoma, for the most part, you have an individual project for each phase of work. So you have a PE project, then when PE's done, then that project's probably going to be closed out. And then you create a brand new project in FEMAS for, say, right-of-way or construction, and that's how it works here in Oklahoma. Some states put all of their phases on one federal project agreement. So what does that mean? If you have all of your phases on one federal project agreement, we're going to be monitoring those end dates a little bit differently than we would here, because you're only going to have one end date, one period of performance for that phase of work, and then when that phase is done, then that project's actually closed, whereas other states, we're going to keep that project open from the beginning of design all the way till the end of construction, and we're going to have to update that end date for whatever phase of work we're currently in. Interfacing with FEMAS. You all interface with FEMAS, but a lot of states don't. So that's the same thing with like number one. We might have to do some extra checks. If you're doing double entry into the state system, and then manual entry into the FEMA system, we might have to do a few more checks to make sure everything looks right. Then, what level of detail does the system track expenditures? This is an area that we've been looking at for a while, and if you're familiar with FEMAS, we have what's called improvement types, which is an identifier of what type of activity is happening. And so, for example, if we're doing construction, we don't just have a construction improvement type, we have probably 7 different improvement types for different construction activities. So if it's a reconstruction, you'll pick reconstruction. If it's an overlay, you'll pick a different improvement type. So it's a lot more detailed in the FEMA system, but a lot of states don't track at the improvement type level. And the reason why we have the improvement type is for determining eligibility. So it's very important that if whatever you're using for an improvement type or an activity to identify what work's being done, is that you have the controls set up to prevent improper billings, which means your system doesn't allow you to bill a cost to an ineligible program code. So what level of detail is that? So we'll look at that. Some states, they only track it project and fund code or program code. That's it. A lot of states, and this is what I recommend, is that you at least track at a project, program, and activity level so you can reduce that risk of charging incorrectly. So who can tell me what level of detail do you track here? Do you track at an activity level or just at project and program code? Well, when your expenses come in and you bill, can you go out and say, okay, we billed, this program code, and can you go out and identify what the activity was, what was being done, whether it was construction or design or safety? Can you drill down to that level, or can you only drill down to the project and the program code level? You can go down all the way? That's good. Yeah, so that's what we want to see, because if you can only go down to program code, then we have a risk there. So we might, and we're not saying that something's happening and that something's wrong, but there's a risk if you can only go down to program code. There's a possible risk, especially if you have multiple funding codes on a project, say safety funds plus regular STBG funds. Well, safety funds have different pro rata share. So if you're billing non-safety items to the safety program code and that's what your system allows, then we have a possibility that you could bill incorrectly to that project, or you could bill non-safety items at the safety federal share, which would be an improper payment. And then you'd have to go back and fix it later. So how are local projects entered into the system? Most of the time, the way we see them is manual entry. The locals will send you over a document, or you'll have an agreement, and you'll just build those into your state system. And then in Oklahoma, you guys push those through to FEMAS electronically, which is good. Then, can you separate out your direct and your indirect costs? Even if you don't claim indirect costs, which in Oklahoma you guys don't, right? You still need to be able to separate out those costs and say, okay, what costs are billable to Federal Highway, the direct costs, and then all of your other costs have to be excluded. So your system has to be able to exclude those non-participating or unallowable or indirect costs. And you guys may not identify them in your system as an indirect or anything like that, but it still needs to be able to exclude those costs from billing Federal Highway.
Do a lot of states use that?
Use indirects? Yes. We say we have 52 divisions, so it's 50 states plus Washington, D.C. and Puerto Rico, and I think 32 states claim indirect costs out of the 52. No, it's not going to be a requirement. It's completely up to the states to, decide if you want to do indirects or not. Because the benefit of indirects is it doesn't give you any extra money, so you still get your $680 million, but you can use some of that for indirects, which basically will free up some of your other state funds that you can use for other things. But it doesn't give you any other funds, and if you're going to use indirects, it's basically going to reduce how much money you can actually put on the roadways. So a lot of states say, we want to use our Fed aid funds 100% for construction, and that's 100% up to the state to do that. Some states, actually Montana, they have a state law that says every state agency will claim indirect costs if the federal awarding agency allows it. So they're required to. So it all depends on the state you're in. Can the system identify and exclude non-participatings or unallawables? That's what we just talked about. So your system has to be able to do that. How are indirects and fringe benefit rates applied? So you guys don't use indirects, but I bet you use a fringe. Is that right? Do you have a fringe benefit rate or no? Labor additive, same thing, yep. So basically what the labor additive or the fringe benefit rate is it allows you to bill the additional costs for your employees. Your employees get a salary or an hourly rate, but then they also get health benefits, they get leave, they get a lot of different extra benefits, and you can build those into a rate and bill those along with the hourly rate and charge the federal government for those fringe benefits. Then, how are billings processed? How often are they submitted, and what is the entity's process for accrued unbilled? So I talked a little bit yesterday about accrued unbilled. We use that a lot with advanced construction, but it's also, if you have a large accrued unbilled balance, and let's say you don't have any advanced construction, then that could be an issue. because we don't have the best cost estimate on projects. So if you have a large accrued unbilled and you have a project out there that is fully expended up to the obligation, but it's still open, and that project's still processing bills, what's going to happen is all of those costs are going to go into your accrued unbilled until you can modify that project, give it put some additional obligation on it, and then you can bill those accrued unbilleds to federal highway. So we want to look at and make sure that we're not carrying these big, large accrued unbilled balances, especially if you don't have AC, because that's a kind of a yellow flag to say, hey, we might have an issue with best cost estimate. But if you have a big, or you have advanced construction, then your accrued unbilled balance, if it's pretty much the same as what your advanced construction balance is, then you're good to go. Okay. So now, internal controls. So this is right out of 2 CFR 200. This is one of the new sections. Internal controls have always been around, but they really didn't have a section in the regulations that talked about it. And this basically says that every non-federal entity must have some sort of internal control process. So you can either use the COSO framework, which we're going to watch a video here in a minute that's going to talk about the COSO framework, which basically is more of a private international internal control framework, or we have the federal internal control framework, which is called the Green Book, which basically is right in line with the COSO framework. So the video that we're going to watch basically will cover both, COSO and Green Book. It's the same information. But you have to have this internal control process in your agency. All non-federal entities that use federal funds should have internal control framework. So what does internal controls do? It makes you comply with, or helps you comply with, the federal regulations and the terms and conditions of the federal award. It helps you evaluate and monitor compliance, because monitoring is a part of and is one of the internal controls. If you do have non-compliance, then this internal control framework tells you what you need to do in order to remedy whatever that non-compliance is. And then what are you going to do? And you need to safeguard personally identifiable information, or PII. You're going to see that a couple times. This also is kind of covered in your single audit section that we're going to talk about later this afternoon. But basically, when you're uploading or providing any kind of public documents or putting things on the internet, you just have to make sure that you're not including personal information of your employees, like social security numbers, addresses. You should be using employee numbers that are not specifically tied to that employee, but it's just a DOT number that you're giving your employees. Not putting any kind of addresses and that kind of stuff out on the internet. So that is an internal control as well. So now let's watch a video. This is another one of those Federal Essentials videos. Okay.
Internal controls are a series of processes and procedures that can help your agency ensure that its activities comply with all laws, regulations, and accepted practices. Internal controls are essential to the proper management and operation of any organization. All personnel in your organization play important roles in supporting internal controls, but management is responsible for designing and implementing the controls based on related cost and benefits. Management also sets the objectives, puts the control mechanisms and activities in place, monitors and evaluates the controls. The principal objectives of internal controls are to ensure the effectiveness and efficiency of operations, reliability of financial reporting, and compliance with applicable laws and regulations. In addition, federal aid recipients, whether grantees or subgrantees, should ensure that transactions are properly recorded and accounted for, transactions are executed in compliance with the provisions of the grant, and funds, property, and other assets are safeguarded against loss from unauthorized use, transfer, exchange, sale, or disposal. The Committee of Sponsoring Organizations of the Treadway Commission developed the most widely used internal control integrated framework in the United States, known as the COSO framework. Public and private organizations use this framework to design, implement, and evaluate controls that facilitate management and compliance with regulations. The 5 components of the COSO framework include the control environment, risk assessment, control activities, information and communication, and monitoring. These 5 components provide clear and effective means to implement and analyze the internal controls of an organization. Let's look at each component, starting with the control environment. Management and employees should have a positive and supportive attitude toward internal controls. Management should convey integrity and ethical values and ensure they are not compromised. Have a commitment to the competence of their staffs by improving their skills, knowledge, and experience. Have a philosophy and operating style appropriate to the development and maintenance of effective internal control. Ensure the organizational structure and assignments of authority and responsibility contribute to effective internal control. And monitor oversight groups to ensure all audit reports and communications are received, and all findings and recommendations are adequately addressed. All organizations and agencies have a purpose or goal, and they achieve these goals by fulfilling specific objectives. However, a risk can endanger achieving an objective. Risk assessment is the process used to identify, analyze, and manage potential risks. Risk identification methods may include qualitative and quantitative ranking activities, management conferences, forecasting and strategic planning, and consideration of previous audit findings. Risk analysis methods may include prioritizing the probability and rate of occurrence, evaluating the vulnerability of assets to any threats, and estimating the quantitative and qualitative costs of those potential threats on assets or operations. Risk management methods may include monitoring the situation, minimizing the risk, taking preventive or corrective action, and continually or periodically reassessing the risk. Control activities include policies, procedures, techniques, and control mechanisms developed and implemented to ensure that your organization's directives are followed. Specific control activities should be established in every area and department to ensure these directives are applied consistently. Some examples of control activities are: access control provides the access a person may have to an asset or resource. Examples are permission or controls to limit access to records and documents, buildings and offices, and information systems. Segregation of duties reduces the risk of error or fraud by one person. Your organization should have adequate segregation of duties in review and authorization of transactions. Authorization control allows only authorized employees to execute and review specific transactions. For example, a clerk may have reviewer authority, while a supervisor would have sole approval authority. Completeness control verifies that all pertinent transactions are processed. Accuracy control verifies that transactions are accurate and calculated using acceptable methodologies. An organization's information and communication systems must convey information clearly, completely, and in a timely manner. Information may be shared formally, such as reporting to management or other agencies, or it may be shared informally, perhaps as a communication with a supplier, customer, or internal employees. Whatever the form, the information should be identified, captured, and communicated in a way and time that give people the means to fulfill their duties. Monitoring is a continuous process that assesses the performance quality of the 5 internal control components over time. Monitoring determines if internal controls are present, sufficient, and effective. External audits, reviews, and internal assessments are forms of monitoring. Any findings, observations, or recommendations from monitoring activities should be addressed promptly. One of the most important concepts to remember is that internal control is a process, not a single event, regulation, or form. Internal controls are an ongoing process that involves everyone in an organization and provides reasonable assurance that all objectives are met. Because factors outside the control or influence of management can affect the agency's ability to achieve all of its goals, no matter how well designed and operated, internal control cannot provide absolute assurance that all objectives will be met. Your agency and staff are responsible for understanding and implementing internal control. Your agency will benefit from implementing internal controls that allow for effective and efficient operations, increase the reliability of financial reporting, and ensure compliance with applicable laws and regulations. For more information about internal controls, contact your State Department of Transportation.
So basically, that internal controls is something that you do all the time. It's a consistent, constant process that you're always doing. When we don't have the video or the capability to have the video, these next two slides, so I'm not going to go through these next two slides that much because this gives you basically what that video just talked about, and it's in your books. But basically, this comes out of the Green Book, but it basically follows the same exact principles that we just watched on the COSO framework. So you have your components, your 5 components, and then all the different principles that are under those components. And then this next slide basically breaks down those principles. So you can see, all the different things that they talked about and all the different things that you have to consider when you're, managing your internal controls and implementing an internal control process in your organization. So any questions on internal controls from the video or this stuff? Kind of a dry subject, but it's very important to making sure that all of your, processes and procedures are going to be in compliance with the rules. So now let's talk about payments. This comes out of 2 CFR 200. So what it says is all payments to states will follow the Cash Management Improvement Act, or CMIA. And what that is it's an agreement between the state of Oklahoma, so not just the DOT, but the whole entire state of Oklahoma and the United States Treasury. And it's an agreement that's done, I think it's done every year, and it's probably your Oklahoma Department of Administration, or maybe it's your Department of Treasury that does this agreement. But it basically identifies how each one of your each one of your state agencies is going to be reimbursed from the federal government and how that process works. So, for example, it will identify clearance patterns. It'll say when you receive a federal reimbursement or federal payment from the federal government in the state of Oklahoma, you're going to turn around that payment and process and pay all of your contractors with that payment within a certain period of time. Usually it's like 1 or 2 days. And the reason why we want to have that clearance pattern is because in the past, we saw where people would receive their $1 million payment from the federal government, they'd put it in the bank, they'd earn some interest on it for a month or two, and then they would go out and pay their contractors with it. What we do in Federal Highway Administration is we primarily work on a reimbursement process. Because if you wanted to, you could do this clearance pattern, but it is a very complex process. You have to do a lot of calculations. You have to look and see how long does it take from when you get a payment and then make that payment out to one of your contractors. How long is that payment? How long does it take for it to clear the bank before that contractor's paid? And so you have to do all this calculation. So what we do in Federal Highway is we do a reimbursement process, so you don't need to worry about that. You've already paid the contractor with state dollars, and you're only going to get reimbursed from Federal Highway, so we don't have to worry about the clearance pattern. But if you want to do that, you can build that into your CMIA agreement. And most of the time, if let's say it's the Oklahoma Treasurer's Office that does this, somebody from that office will work with all the different departments in Oklahoma to identify what those clearance patterns are going to be, and they'll build it into this agreement. Other non-federal entities, other than the state, we have to still do the same thing, is we have to make sure, and this would be the Oklahoma DOT that's working with your LPAs or say the MPOs, you would have to identify what their clearance patterns are if they didn't want to work on a reimbursement basis. But as with the states, State DOTs do a reimbursement basis with the local governments most of the time, so it's really not an issue. The one thing to remember, though, is it does say we have to pay other non-federal entities within 30 days. And that's within 30 days of receiving a good payment to actually be able to be paid. So let's say an MPO submits a bill to Oklahoma DOT, and you have to return it to them because it's missing documentation, or you can't support what they want to get paid, and you submit it back to them. When they actually give you something that is payable, that has all the supporting documentation, you have then 30 days. Now, that's probably not a good example because we do have a conflict in our law, and that's 23 USC, that basically says MPOs will get paid within 15 days. And so because that's in our law, if you remember when Laura talked about the hierarchy of law, law is higher than regulation. So our law, 23 USC, overrides what it says in 2 CFR 200, but it's only for PL funds. So if you have an MPO that's using something other than PL funds, then they would follow the 30 days. But if it's PL funds, then we must pay the MPOs within 15 days, and that's in our law in 23 USC. So there's a little contradiction there, but we have to follow the hierarchy of law principle, and so that makes us follow the law versus the regulation. So just remember, MPOs, PL funds, 15 days. Any other type of funds, we follow what's in 2 CFR 200 that says they must be paid within 30 days. So how does the payment flow in our program? For the most part, because we do a reimbursement process, the state actually incurs the cost and pays the contractor before you ask for reimbursement from Federal Highway. So you can see up there, contractor does the work, contractor bills the state pays the contractor, then the state will submit the bill, or it'll go into what we call the current bill, and it'll collect all the different bills, and then you bill those. How often do you guys submit a current bill? Once or twice a week? Once a week. Okay. So once a week, you'll collect all of your payments, and you'll submit those to the division office through our FEMA's current bill, and we'll pay that. And once we sign off on it, it goes to U.S. Treasury, and then it's usually turned around within 24 to 48 hours of payment back to the state. And it's all electronic now. For the most part, I think there might be a few people out there that still do checks, but I think all states, one of the requirements is to have electronic payments. So I think all states, we do electronic payments from U.S. Treasury to the states. Now, your state treasurer's office probably is going to be accepting all of these payments, and then they have to go through them all and figure out, okay, this is a, Oklahoma DOT payment, this is a Department of Education payment, so they'll have to sort through all the different federal payments that come in and, put them into the proper bank accounts and transfer them to the proper departments. But it's usually a 24 to 48 hour process. It's pretty quick. So 2 CFR 200 talks about cost sharing and matching. In general, basically it's talking about what is cost sharing or matching. It's a portion of the project cost that's not paid with federal funds. So that's going to be the state share or the local share is what we call it. Even if you're using match, you still have to verify. It has to be verifiable in your record. So we heard yesterday that primarily your match is toll credits. And we also heard that you have a good tracking mechanism for those, so that's good. So we should be, if you're using a toll credit on a project, and let's say it's $1,000, and our share is 80/20, you're going to bill Federal Highway $1,000, and we're going to pay you $1,000, but you need to show that you have $200 worth of toll credits that is there to support your match, that meets your match. And your system has to be able to say, okay, here's the $200, it needs to apply to that project, it needs to not have the capability to apply that to, say, another project. So your system has to be able to track that. Same thing with cash. I mean, cash is a lot easier. If you're paying a $1,000 contractor payment and then you're billing us $800, our federal share, if we go to your records, we should see, hey, look, Oklahoma DOT spent $1,000, they paid the contractor $1,000, and we're kicking in, and they're asking for reimbursement of the federal share, which is 80%. You cannot include contributions in any other award, so you can only, basically you can't double dip. You can't use the same match on two different projects. You can only use it one time. Necessary and reasonable. Laura's going to talk about that in more detail when we get into the cost principles, but basically we have to still apply the cost principles of necessary and reasonable even on match. So let's say, for example, you're using donations. Rec Trails does donations a lot, or they do volunteer time. So if you have somebody that's out there clearing a trail and they're volunteers and you want to use the value of those volunteers as your match, it has to be necessary and reasonable. So if you have a lawyer doing the clearing, are we going to pay them lawyer wages, or are we going to pay them what it would cost to actually hire somebody to do the actual work? That's what we're going to do, is we're going to hire, or we're going to pay them not just what they would make out doing their regular job, but actually what you would have to go out and pay somebody to do that. So just make sure that when you're doing match or looking at value of match, that you're using that necessary and reasonable. Also necessary, whatever you're using as match has to be necessary to the project. There has to be a cost-benefit relationship, because if there's not, then you shouldn't be using that match on that project. Allowable, it has to be allowable. Even if it's a donation, it still has to be an allowable item. So if you were having to go out and buy it, it would still have to meet that allowability principle. And we'll talk about that in more detail in subpart E. Not federally funded under another award unless authorized by statute. So that's basically saying that you can't use federal dollars as your match unless it's in the statute. And we actually have rules that say, yes, sometimes we can use like Federal Land Management Agency funds, like U.S. Forest Service, for a match on a rec trails project. We can use federal lands highway dollars, which are federal dollars, as match to a federal aid highway program project. And that's actually, even though it's federal dollars, we call it as the non-federal match. So we do have some things in our law that allow it, but for the most part, it's going to be a non-federal type of a match that's required. And if you're going to use matching, you have to make sure that you're documenting that in your work program, in your budget for your project. All of that stuff has to be included. Even if there's no funds, actual cash, moving around, it's just a donation or a value, you still have to incorporate that into the total cost of the project, because it would be a cost if you didn't get a donation. You would have to pay for it. So, and we also have to use that when we're figuring out what your pro rata is. Yes? Okay. There still has to be a cost-benefit relationship, and I'm going to have a slide here in a minute that talks about in-kind very specifically. So an in-kind would be third-party in-kind, and that's really the only kind. That's the only in-kind that we allow is third-party. And when we talk about third-party, it's a party that has an interest in the project but is not the federal agency or the administrator of the project. So I guess my question is, I'm not sure, but maybe we would call it something other than in kind, though, because I'm not saying that what they're doing is wrong. I'm just saying that maybe it wouldn't be considered in kind. Maybe it would be just a regular match. But then my next question, though, is the work that they're doing, that they're going to use as in kind match, does it benefit the activity or the whatever the MPO is doing, or is it just something that the state did in that area, but it really doesn't relate to the activity that's going on? And then what are they using their PL funds for? So like if, let's say the state comes out and they do a section of road, right? Are you talking about construction? What? I guess you would have to look at the overall project or activity. Let's say, okay, we have this activity that's going to do counts, and it's going to cost us $100,000. Then the state comes in and they do the counts for them, right? And let's say the value of that is $200,000, or I'm sorry, $20,000. So the federal share is going to be $80,000. But what are the other costs that are going to happen if the state's already done the counts? You know what I'm saying? Yeah, maybe we'll talk offline. Because there just has to be a cost-benefit relationship to it. So if the state does some work in an area and they want to use that as match, the match actually has to be for the activity that is happening. So it can't be, hey, the state did some counts and we're going to use that match or that value on another activity in the work program, because then it wouldn't necessarily benefit that specific task. But then what we have to talk about is planning is different. Planning, you guys have one federal project that basically represents, could represent 20 or 30 or 100 activities. So we allow you to move things around within those activities. So maybe on a break we'll talk about it in more detail. Okay, let's talk about federal share. And we're going to go back into your book here in a minute on the next slide to talk about the different things that change that federal share. So if you want to start flipping to the federal share in Appendix 5. So the standard share, and this is in our U.S. code, so 23 U.S.C. 120 is where all of our federal share guidelines are. And if you are reading through the law, let's say you're going to look up and I'm going to use rail highway crossing as an example because we had a big issue with this this last year, where rail highway crossing is a set aside out of HSIP, out of your main Highway Safety Improvement Program funds. Well, if you read the HSIP section in 23 U.S.C., it says the federal share shall be in accordance with 23 U.S.C. 120, which it's referencing here. And on this next slide, also, these are all of our special rates for 23 U.S.C. 120. So basically what it's saying is, hey, your Highway Safety Improvement Program funds can use, say, sliding scale. And we'll talk about what sliding scale is here in a minute. But what happened was a lot of states said, okay, well, we have this rail highway crossing funds. It's a set aside out of HSIP. So we assumed that those rail highway crossing funds also could use sliding scale. And that was an incorrect assumption, because if you go to the section in 23 U.S.C. that talks about rail highway crossing, which is a completely separate section from the HSIP section, it says the federal share shall be 90%. That's it. It does not reference back to 120, so sliding scale does not apply. So a lot of states actually had to go back and adjust their rail highway crossing projects down to the 90% if they had a higher percentage on there, and had to pay back. Some of them had to pay back funds. So you have to really, read through the law or look at the fact sheets. I wouldn't recommend reading through the law because it makes it a lot more difficult, but we do have fact sheets that kind of summarize all this stuff. And there's a whole section that says federal share, and it'll tell you exactly what it is, if it's in accordance with 120 or if it has its own federal share. So just make sure that you're aware of all the different shares that we have out there. So in general, we're an 80-20 program. We heard yesterday, yes, on interstates, it's a 90-10. So if you're using any of your funds on the interstate, it's a 90-10 match. If you're using any of your funds off of the interstate, it's generally an 80-20 match. And you can see up there all of the different programs that use the 80 or the 90. Then we have some 100%, we have 100% programs. So tribal, and most of them are all of our federal lands. So tribal transportation, federal lands highway program, territorial program, those are all at 100%. They don't have to have a non-federal match. Then we have ER. So I heard you guys have an ER event recently, or you just received some funding for ER? Right. So ER could be 80 all the way up to 100%, and it all depends on the work that you're doing and the time frame. So the first 180 days of the event and emergency repair work is at 100%. After 180 days and permanent repair work is going to be at the standard sliding scale or the 80%. So you have to really understand what kind of work is being done. Are we doing emergency repair work just to get the roadway open so the public can safely drive on it, or are we doing a reconstruction to repair that roadway that was damaged and you're going to build it back up to at least what it was before or better? That would be permanent repair, and that's going to be at your regular standard federal share. And so just remember, first 180 days, emergency repair, you can be at 100%. After 180 days for permanent repair, we're going to be at the regular standard share. So now let's look at all the different things that can change the federal share. And this is going to be in the back of your book. On the page that has all the text, it has a lot of good references, and it tells you where you can find this information. And then on this sheet, it basically gives you every single program that we have, and then you can see which programs allow the different flexibilities. So like just up at the top, you can see all of our formula programs, the 6 main programs, all of those qualify for sliding scale. All of them but metropolitan planning qualify for the 100% for designated safety projects. So if you look up here, we have sliding scale. What sliding scale means is that the amount of federal lands that you have in your state, and you have to have at least a minimum of 5% in order to qualify, those are federal lands that the state can't earn revenue on because they're federal government lands. So you can't earn any revenue on them. So states that have at least 5% or more get a extra little piece of federal share added to their regular 80% rate. And so we talked yesterday and we heard that Oklahoma does not use sliding scale, but you actually do qualify. And I went out and looked at your rate, and it's 80.58. So basically you're getting a 0.58% bump, so that's probably why you don't use it. It's probably not worth it, because if you do use it, you have to show a maintenance of effort, and you have to do a maintenance of effort that says, okay, the 0.58 savings that we received enabled us to do these extra projects. So it's probably too burdensome for less than 1%. So you guys just stick at the 80-20. Like I said yesterday, I think Nevada actually has the most federal lands, and I was in Nevada, and they're at the maximum sliding scale of 95%. So their program is 95% federal, 5% state or local share. When I was in Wyoming, they were at 90.49. So it varies by state. Most of the western states have sliding scale. The eastern states don't even meet the 5% minimum criteria, so they don't even qualify for sliding scale. But you can go out. We have a notice out there, and you can look up the sliding scale notice on our website, and you can find all the different states that qualify for sliding scale. But sliding scale doesn't apply on every single program. So you can see up there some programs you cannot use sliding scale, like SPR. We've seen in the past where folks think that SPR qualifies because it's also a set-aside out of our major programs, but it's very specific in that section of the law that says that SPR has to have a standard 80-20 federal share. Then, maximum of an 80% for toll projects. So if it's a toll project and you do qualify for sliding scale, that one does not apply. Maximum is 80%. We used to have an increased federal share for freight, but because now we have a dedicated freight program, an HFP program, that was repealed, and now, as you can see up there, NHFP just falls under the regular sliding scale. Then we have these 100%. So 100% for designated safety projects. You can only use it in those programs, and you have to go to the law, and if you look in your book, it basically tells you for your safety projects, it's the first bullet under the text here, If you go to 23 U.S.C. 120, paragraph C1, it will give you a list of what types of safety activities would qualify for this 100%. So if you're doing a safety project or some safety activities that meet that definition, you could, and you would have to, at the project authorization point, say, we want to use 100% safety. We're going to use this provision. There's actually a check in FEMAS that tracks it because you can only use up to a certain amount per year. You can't do all of your safety stuff at 100%. You can only use up to, I'll have to look up exactly what the percentage is, but it's like 10 or 15% of your HSIP dollars or something like that, and it tracks it. So you could do a lot of your projects or some of your projects up to that 100% if it meets the definitions. Innovative delivery methods is similar, but it's basically up to 100%. So basically what happens is you get an extra 5% bump if you are doing an innovative project delivery method on a project. You get an extra 5%. And it says up to 100% because, like, let's say we're in Nevada, if they get an extra 5%, they would be at 100%, but you all would be up to 85%. So it depends, but notice there's only 3 programs that qualify for that innovative program delivery method: Metropolitan Planning, NHPP, and STBG. Then Appalachia Development Highway System, you guys don't have those funds, so that wouldn't apply to you, but those are at 100% for all the states that get those funds. Then 100% for workforce development. What a lot of states don't know is you can actually use your regular program dollars to pay for workforce development or training for your employees at 100%. And so what we see, some states do this and some states don't. This would be similar to, like, if you're deciding that you want all your federal dollars to go to projects, you may not decide to do this. But we see with NHI classes, NHI, the National Highway Institute, actually charges a participant for each participant. It could be from $250. I've seen some going all the way up to $800 a person. And you could bring an NHI course to Oklahoma. Let's say you have 20 people that are going to attend. It's going to cost you $10,000. You can set up a project in FEMAS for $10,000, 100% federal, and you can pay for that NHI course and those participants using your federal dollars and using this provision of 100% workforce development. And it doesn't just apply to NHI courses. It applies to any workforce development of your employees that benefits the agency and has a relation to transportation. And all that information is also in 23 U.S.C. 120 where it breaks that out. Actually, workforce development, that section's in 504. So it's 23 U.S.C. 504, so you would have to go to that chapter 5 to read what it talks about there. But basically it just says, it's for the training. It can't be used for salaries or travel. It's just for the training activity. So if you have to have people travel to a training, like an NHI class, you can pay for their registration fee with this, but you cannot pay their travel or their salaries with that. Then, up to 100% projects within Indian reservations, national parks, and monuments using apportioned funds. So basically we saw on the previous screen that tribal transportation, federal lands, those are all at 100%. But let's say we're going to help a tribe and they're going to be using their TTP funds, plus the state's going to kick in some STBG to help them out. That STBG could be up to 100% as well. But it has to be on tribal reservation lands or national parks and monuments. So any questions on federal share? Okay. So now let's talk about different sources excuse me, of match. So the most standard is state and local funds. Cash match, that's pretty easy. You pay for the bill and you bill us our share. Then we have third-party cash donation and third-party in-kind donation. So we just talked really briefly about in-kind, and I'm going to have another slide that goes into it a little bit more detail. But basically what this means is A third party is somebody who has an interest in the project but is not administering the project and is not the federal agency. So it could be a cash donation. One example of that is, I believe it was in Utah, where there was a private company. The state DOT was building an interchange off of the interstate, and a private company was going to benefit from that interchange, and so they actually kicked in $3 million as match because they had an interest, because their employees were having to drive through this residential neighborhood to get to the building, and this new interchange was going to, prevent them from having to drive through the residential neighborhood and give them more direct access to their work. So that company actually kicked in, a few $1 million, pretty big chunk of change, and they were able to get that interchange for their company, and it still benefited the state system. In kind would be donations or something other than cash that would go to the match, and that would also be from third parties. Then we have credit for donated private property or for land lawfully obtained by the state without federal funds. That would be, you would have to follow the right-of-way procedures. So basically, and we see this a lot, the state, you all have, you own property or you own right-of-way, and if, let's say you're widening a road and you own the right-of-way there, you can use the value of that as match. Or maybe you have a private party that wants to donate the land. You can use that as match. It has to be fair market value, so you have to make sure you have a good appraisal and you follow all of the Uniform Act rules in 49 CFR, but you can use donated private property and land for match. Other federal agencies, if permitted by law, mentioned that a little bit. We have some programs that allow U.S. Forest Service or other federal land management agency dollars to be used as the non-federal match, but it has to be in law. Most of the time we're looking for state and local match of some sort. We can do federal lands highway program funds for joint federal aid and federal lands projects. So we can actually use federal land dollars as match, as the non-federal match to a federal highway project. And then you guys use the toll and bridge credits, or the toll credits here. So toll credits, that's a really good way to match your projects without actually having to come up with cash. So third party in kind. Let's go to the green box first because that's our definition. A third party is an entity other than a recipient or subrecipient or the federal agency that's not party to a federal aid project agreement, but who may have an interest in that. So third party in kind can be used to satisfy the non-federal match requirements for a project under the federal aid highway program. You still have to document that. It can be incorporated through an amendment, so you don't have to identify it at the very, very beginning, because maybe you don't know that there's going to be a donation, but later as the project's progressing, you identify that there's going to be a third-party donation. You can come back after the fact and modify that project. Of course, make sure that you're doing all of this before you incur costs or do anything like that, but you can do it through an amendment. Retroactive approval of costs incurred prior to authorization is prohibited. So that's what I was just talking about. We don't want to incur any costs before authorization. Otherwise, you may get stuck having to pay for it with just state dollars. Total contributions of cash and or donations from all non-federal sources plus the federal funds may not exceed the total cost of the project. So if you're getting a donation that's more than what's required, let's say we have a $100,000 project, and you get and it's an 80-20 project, and you get a donation for $40,000 of value that you want to use as match, we can't say, okay, we're only going to use $20,000 of that as our match and still get $80,000 from the feds. Now you're going to be overmatched. So basically you have to use the actual value, and if it's more than what the state share is required, you're going to be overmatched, and the share is going to be now a 60-40 versus an 80-20. So just make sure that you're using the total value and you're not reducing the value to just what you need for match, because we have to include the total cost and the total value. And that's what that last bullet basically says. Each dollar of excess donations reduces a like amount of federal share. So tapered match, mentioned this yesterday. I don't think you guys said you used this. But basically, this is a flexibility that allows you to, you still have to maintain in the end your regular federal share, let's say 80-20, but maybe at the beginning of the project, you have some extra local dollars or state funds that you can put into the project, or maybe there's a donation that's going to allow you to meet that match at the very beginning. So you would have to do a tapered match requirement because all of your future billings are going to be at a share different than the 80-20 per bill. As long as at the end of the project, your federal share matches to what was authorized in the agreement, 80-20, then you can use this tapered match. And it would work the opposite way too. Maybe you're going to be getting more of your state funds or your donation later down the road on the project, so you want to bill the feds a little bit more at the beginning. Like maybe you'll be billing 100% in the beginning, and then towards the end of the project, you're going to make up that state share. And as long as at the end it's an 80-20, then you can do that. But you have to get this approved at the very beginning of the project, so you can't decide to do it later. And you have to meet those criteria there. The division administrator has to approve it. This is not something that we allow the state to assume. So you have to, if you're going to use tapered match, it's not something that you can approve and authorize yourself. You still have to go through the division office and get the approval. And you have to meet one of those 4 criteria. You know, tapered match is going to allow you to complete the project faster. Or you're going to reduce your costs by using tapered match. Or it's going to provide for some additional non-federal funds to be leveraged that wouldn't normally be available if you use tapered match. Or the last one, when costs for services are donated by an LPA acting as a third party or incurred by an LPA as a subrecipient, or in limited circumstances, a state agency acting as a recipient. And that was recently added, and that's kind of a catch-all one that basically allows you to use tapered match because you can probably document that you could meet that 4th bullet if you want to use tapered match. But your system has to be able to track this. So when we're talking about systems, you have to be able to track this and make sure that you're meeting that match at the end of the project. And if there's a shortfall, let's say we fronted the federal dollars up front and we're getting to the end of the project, and you know, we see this sometimes with locals. Hey, we thought we were going to have enough state or local dollars, but now we're strapped and we're not sure if we're going to be able to meet the match. That's going to be an issue because the requirement is you have to make your match. So maybe the state would have to kick in some funds, or you know, if that's not going to happen, it could possibly be they have to pay back federal dollars. So it's really important that your systems can track this and make sure that you're always going to maintain that match at the end of the project. So program income, this is what it says in 2 CFR 200. And then over there with the Federal Highway Shield, you can see those are some examples of what we use commonly in our program for program income. So we actually recommend and encourage program income. If you can offset the cost of a project by earning some sort of income, that's going to be a benefit to both the state and the federal government. You have to report net of the cost to earn it. So your income has to be your net income, not your gross income. So you're going to have expenses possibly, so you want to report the cost net after the expenses are taken out. Then earnings from sale or surplus property and taxes are not considered program income. So if you have to, you know, surplus some equipment and you get some funding for that, that's not considered program income. And you may be added to the amount of the grant or used to meet cost sharing requirements. So yeah, you could use program income to meet your match. That's actually what you guys do with your toll credits. So tolling and road pricing, those are probably the most primary and biggest program income things that we use in Federal Highway Administration, or any other fees or revenue earned during a project. When I was in Wyoming, they actually earned a very small amount of income on projects, and we required them to account for that. And what they used to do, and I think they still do it, is they would create these bid packages for the contractors, and there was a cost associated with creating the bid packages, you know, copy costs, and they would be these really big packages. And if you wanted to bid on a project as a contractor, you had to buy that bid pack. and they made a tiny bit of income off of that. You know, their costs to make it, they sold it for just a little bit more than what their costs were, and so they had to adjust their projects down for all the income that they made from the contractors that bought those. So they had to track that, and they had to adjust their project costs down. That's just another example, a small one. But it doesn't matter how much you're making. If you're making any income, you have to offset the cost of the project with that income. All right, let's talk about property now. So property, we have real property. Up there you can see means land, including land improvements and structures. So this would be like our right-of-way program. So this is 2 CFR 200, so it's talking about what the property standards are across federal government and what the requirements are, and then we have very specific requirements for real property in our program. So what it's basically saying is real property has to be used for authorized purposes. So whatever property you're going to incorporate or use as a value on your project, there has to be a cost-benefit relationship, and it has to be used for authorized purposes. Even if federal dollars buy right-of-way, the title still rests with the non-federal entity. So ODOT would retain title to any right-of-way that's procured with federal dollars. When you're done with that property, if you are done with it and you no longer need it for a project, you can either retain the title, sell the property, or transfer the title. If it's no longer needed for the project, and even if you decide to retain the title and keep that property, you're still going to have to pay back Federal Highway Administration our share of the fair market value on that if you're no longer going to use it. If you sell it, same thing. And if you transfer it, same thing. If it's no longer needed for the federal project and we participated, you have to pay us back our fair share of that property. Now, a lot of times it's incorporated into the project and you won't have to pay us back because it's, you know, you're going to keep that indefinitely for however long that project needs that property, which could be forever. So in our program, 23 CFR Part 710, and under that second bullet, 49 CFR Part 24, this is what we have to follow for real property in Federal Highway Administration, is our right-of-way and real estate manual. So state DOTs, you have the overall responsibility for acquisition, management, and disposal of real property for federal projects. Every state must have an up-to-date right-of-way manual. That's one of our requirements in 49 CFR Part 24. And Federal Highway has to approve that manual. And now, are there right-of-way folks in here? I think most all states do pretty good at this, and our division offices have right-of-way folks in there that kind of monitor this and keep up to date on, you know, the changes in your manual. But every state, you do have to have a right-of-way manual, and it has to be approved by Federal Highway. And right-of-way acquisition shall not occur prior to the NEPA determination. So I'd mentioned that a few times yesterday. If we're done with design and we're ready to move to the right-of-way phase, NEPA has to be done. You have to have a NEPA determination. But we do have in 710.501 some provisions for early acquisition of right-of-way that kind of give us a little bit of an exception to that NEPA determination, but it has to be very specifically followed in those circumstances in 710. So make sure it's not going to be something that you can do all the time. You have to meet certain criteria and conditions in order to do that early acquisition of right-of-way. Okay, so now let's talk about personal property. And they identify two different things, tangible and intangible. We're not going to get too much into the intangibles, but basically if there are trademarks, copyrights, patents, there's values to those, and those we have to participate in those, and if something was to happen, you may have to pay us back federal dollars. But that doesn't really happen too much in Federal Highway Administration. But the tangible ones, equipment and supplies, we see that a lot. So equipment. The definition of equipment, and this is the federal definition, is you have a useful life of greater than 1 year and an acquisition cost of equal to or greater than $5,000. And so this is per item. So if you're going out and buying a computer, and this is one of the things that I want to mention when we're talking in the next module about the cost principles, and we have the selected items of cost. and you're wanting to identify or say, hey, is our computers an allowable cost, there's no selected items of cost for computers. So you have to think about, okay, how much was the computer? If you're buying a really high-end computer that's more than $5,000, then we're going to follow the equipment rules. If you're buying, you know, a computer, a $1,500 computer or a $1,000 computer, it doesn't meet the definition of an equipment because it doesn't have that acquisition cost of greater than $5,000, then we're going to treat that as a supply. So you have to kind of think about what you're buying and what the values are and kind of meet the definitions of, is it equipment or is it a supply? So basically it's the same thing. If we're using federal dollars to buy equipment, the title rests with the non-federal entity. You all keep the title. It has to be used for proper authorized use. If we're going to buy a piece of equipment, it needs to be used for transportation activities and or for the project that you're using the equipment on. It could be used in other activities, but the primary activity has to be for federal highway purposes or highway purposes. You also have to have good internal controls on your equipment. That's basically what the management controls talks about. You have to have good property records. You have to do at least an inventory every 2 years. And you have to have a good loss prevention program. So if things are stolen, you have to have, you know, your tracking codes on there or your inventory codes, a way to track pilferable types of things. So like if you do have laptops or tablets or something that you're issuing your employees, you have to make sure that you're doing a regular inventory to make sure that those things aren't getting lost or stolen. So you have to make sure you have those good programs. Now let's look over there in the little green box. So in federal highway, we normally do not participate in the capital purchase of equipment. When I say capital purchase, you can't go out and say, hey, we want to buy a car for our MPO, and we're going to bill that car, the entire purchase of that car, to a work program activity. That would be an unallowable cost, and it is not allowed with federal highway dollars. That would be a direct bill. You also cannot put your capital purchase into your indirect costs. So how do you recoup the cost of this equipment or of that vehicle? The intent is the MPO or the state, whoever it is, you buy the vehicle with your state or local dollars, and then you can charge the cost of that vehicle to projects as you're using it. So what we see a lot of times in the States is you all own all your vehicles, but if you have an engineer that's driving out to go visit a project or do a project inspection, they can say, hey, I'm checking out this truck, and I'm driving 200 miles at 50 cents a mile, and 200 miles back at 50 cents a mile, and you can bill $200 for that vehicle on that project. And that's just a one-time charge for the use of that vehicle. So you have to come up with rates. And you can use the IRS rate, but I see a lot of states you can develop your own rates. And that rate can include the depreciation, which basically is the purchase price prorated over the useful life. So basically if you have a $30,000 vehicle, it's got a useful life of 5 years. You basically divide that 30,000 by 60 months, and you have a monthly rate. And so you can throw that into your equipment rate or into your mileage rate. You can track all of your fuel costs, and you can dump that into your rate. You can get your maintenance costs. You can dump that into your rate. And once you've come up with what your actual total costs are for the year, and then you need to figure out how much are we going to use this vehicle, what's our estimated usage. Let's say we're going to drive this vehicle 80,000 miles this year. Then you're going to do the basic calculation of dividing your costs into your usage to come up with a rate, a per mile rate that you're going to use. And you can do that for any type of equipment. It doesn't have to be mileage. It could be an hourly rate for some piece of construction equipment that you want to build to a project. So that is the way in Federal Highway Administration that we expect the equipment cost to be billed to projects. So you cannot generally bill the capital purchase of equipment to any of our projects. So rec trails, this is a big deal for rec trails because rec trails actually says in our law that these funds can be used to procure equipment. So sometimes we do have those exceptions to the rule, but now let's jump over here. Okay, it's in 2 more slides. You have to make sure that you still follow the Buy America rules. And so Buy America says that you cannot incorporate iron or steel that's not made in America into a project. That's pretty easy when you're thinking about construction project and you're talking about rebar or bridge girders, steel bridge girders, things like that. But it also applies to equipment. So what we see a lot of times is, say, Rec Trails, the DNR wants to buy an ATV to use on trails, and that's a legit cost. It makes sense, but if you're going to buy that ATV, even the screws and the bolts and the washers that are on that ATV have to be made in America. And so you have to get a Buy America certification that says, yes, all iron and steel on this ATV are made in America, which I can tell you, I don't think there's any ATVs out there that are 100% made in America. So then the next step is you have to get a waiver, and we're not doing waivers. The current administration says no Buy America waivers, and so we have not approved a Buy America waiver for several years. So if you want to buy a piece of equipment for Rec Trails, you're probably going to be out of luck. So my recommendation for Rec Trails is let's rent. Rent, if you need an ATV, instead of going out and buying it, figure out what it would cost to rent one, and you can bill that rental cost to the project as you're using it. When you're done with that ATV, you can turn it in, and you no longer have to bill anything, and you don't have a cost that you have to track anymore. Yeah, so that's a good question. You amortize that vehicle over the 5 years. You've fully amortized it. It's fully depreciated, let's say. There's still probably going to be a value. So even though you fully depreciated it, if you don't need it anymore and you dispose of it and the fair market value is more than $5,000 when you're disposing of it, you would still have to pay us back our share of whatever the value is. If it's less than $5,000 when you're done with it, then we don't care. You can keep the funds, you can donate the property, but you do have to document the fair market value. You can't say, well, fair market value is $10,000, and I recently got a question on this, is like $10,000, but we're going to donate it, and it made 100% sense. It was an MPO that wanted to donate a vehicle that they had procured with federal dollars, which technically was not a good thing that they did, but since they did do it, they wanted to donate it to a local, I think it was a senior citizen center to have them have a vehicle, and that made sense, and everything was good, but that senior center has no relation to Federal Highway. We participated in that, and even though they were going to donate it and give it to them for free, they are still required to get the fair market value and pay us back our share, and then they can do whatever they want with it. So yeah, even if it's for a good reason or a good purpose, if there's not a benefit to Federal Highway and you're no longer going to use that, if there is a value of greater than $5,000, then you have to pay back our share. So that's what up here it says. The title remains with the non-federal entity, but when you're done with it, you have to look at that fair market value. And so with real estate and right-of-way, it's pretty easy. You can go out and just get a formal appraisal. When we're talking cars, you may not be able to get an appraisal on a car, so you're going to have to go out and do some research. Hey, what is a vehicle of this year and this condition? Not just what it's going for, what people have it for sale on the internet, but what they're actually selling for. And so you have to document that you actually went out and found what the fair market value was, and use that as your documentation for whether you need to pay us back or not. If it's less than $5,000, you don't. And if it's more than $5,000, you should be paying us back. Okay, this is the slide I was wanting to get to. So this is our exception to the rule. And this is fairly new. I think it came out in 2018. But basically, this is a memo that was issued by the Chief Financial Officer of Federal Highway and our Office of Infrastructure. So our Office of Infrastructure and the CFO issued this joint memo that basically said that we will allow certain construction and safety equipment to be procured using federal dollars, the full capital purchase, and you can charge those directly to an individual project. So you would actually set up a project, a separate project, to buy this piece of equipment. Once it's purchased, then you would bill the federal government on that project, and we would reimburse you, and then that project would be complete. So the project would be set up just to buy the equipment. But there's a whole bunch of things that you have to follow in order to do this. So basically, you have to first provide these assurances. So are you going to use this piece of equipment that you're buying within 3 months on an authorized federal project? Are you going to use it for its intended purpose over its useful life? So you're going to have to figure out what is the useful life, and are we going to use it over that period? And you have to provide the annual number and types of projects that you're going to use that equipment on. You have to document and monitor all the activities that you're using it on throughout its life. You have to make sure that it's not going to, we're going to go out and buy it and it's going to sit in a garage for a year or two. You have to use it and not have it be idle for extended periods of time. You have to have good internal controls to make sure that everything is tracked and that we're not using federal dollars on unallowable types of activities, or we're not using that piece of equipment on unallowable activities. And then once you've provided those assurances, then you have to follow all of these additional rules. So basically in 635, we have the use of publicly owned equipment, which basically says that if we're going to use state DOT equipment, you have to show that it's in the public's best interest to use state equipment versus the contractor. Sorry. Because the intent of our program is we're gonna provide opportunities for contractors to bid on projects, and the contractors are going to use their own equipment. So that's generally what the intent of our program is, but sometimes it is in the public's best interest to have the state either use your own forces to do the work instead of hiring a contractor, or possibly using your own equipment instead of having the contractors use their equipment. So you have to just show that public interest. Then same thing with the materials and product selection requirements, same kind of thing. You have to show it's in the public's best interest for the state furnished materials to be used versus getting a contractor. And then you still have to follow Buy America. So here's where we're kind of having a problem, is because we're not authorizing any Buy America waivers currently. So unless that equipment doesn't have any iron or steel in it, it's probably going to be difficult to use this provision, because we're not actually allowing or approving any waivers right now. But there are some pieces of equipment out there that may not have iron or steel, so it's not an issue. Then after all of that, all the assurances and these provisions are followed, then the DA in the division, and this cannot be delegated down to the DDA, the Deputy Division Administrator, the DA has to approve the purchase of that equipment. It has to be in writing. It has to be like a formal letter that says we're going to allow the state of Oklahoma to buy this piece of equipment. Then once we've done that, then you can go out and set up a project and go out and procure that equipment. So now let's talk about the type of funding you would use. If you go out and buy that equipment with NHPP dollars, you can only use that equipment on NHS routes. It would not be appropriate to use that equipment on non-NHS routes because you only used NHPP dollars, and those are only supposed to be used on NHS routes. So my recommendation is, if you're going to use this provision, use STBG, because then you can use it anywhere. STBGs are most flexible. You can put those funds on the NHS routes. You can put them on non-NHS routes. So if you are going to use this provision, I highly recommend using STBG, because then you don't have any issues with eligibility of where you can use that equipment. So any questions on this? Yes? Survey instruments? Possibly. It depends on the value. If they're more than $5,000, then are you talking about using this provision? Yeah, we would have to probably run it up the chain to ask, because the one problem with this is I think when they initially approved this, it was for these barriers for traffic control. I guess there was a state out there that wanted to purchase these, and they kept asking Federal Highway, so our infrastructure and CFO came up with this, but then it kind of opened the door to, hey, let's see what all this type of equipment that we could use. And so it's possible that we could, but we would have to run it up the chain, and they would still have to follow all of those assurances. So how long does a survey equipment usually, can you use them multiple times over a long period of time? Oh, okay. And how, are they pretty pricey? It's possible, I think. Yeah, I think it might be possible. But yeah, they would just have to do these assurances, you know, what projects are they going to use them on, how long are they going to use it for, you know, it's a very formal process. They'll have to follow that. And I think the letters, do you guys have the letter? Did you get I'm sure you guys got the memo in the division. So yeah, it very well could possibly be something that you could do. But they wouldn't actually do it as a pay item, and they wouldn't charge it to that particular project. They would have to do the individual project to buy them, and you know, who knows, maybe they could buy a couple of them that would manage the whole state. Now, are those items that the contractors usually provide? The survey instruments? Like who normally provides those in a project if you need to use it? Okay. Yeah, I think it's possible you could use that. Okay, now let's talk about Buy America a little bit more. So basically what this says, and this is in 23 CFR 635.410, and some people might have heard of Buy America, some people might have heard of Buy American. They're two different things. Buy American basically applies to the whole federal government. Buy America is very, very specific to federal highway. And Buy America is also a lot more strict than Buy American. So Buy America basically says that we cannot approve a project unless these criteria are met. So if there's no permanently incorporated steel or iron, then you know, it's pretty easy. We can approve it. There's no iron or steel in the project. If there is iron or steel in the project, all manufacturing processes, including the application of a coating, have to occur in the United States. So if you can verify and justify, yes, the iron and steel that we're putting into this project are manufactured in the U.S., then you're good to go, and we can provide approval. If you cannot identify or cannot find iron or steel that is made in America, then you can do what's called alternate bid provisions, which basically says you have to put out two bids, one for foreign, one for domestic, and if the difference is the foreign steel is cheaper by 25% or more than the domestic steel, then you have to document all this, then you can go ahead and procure that. So without getting a waiver. So you have to do those alternate bid provisions. You have to get bids for both. And if you can identify and support, hey, the foreign steel that we want to buy is 25% less expensive or more than the domestic steel, then you could procure that foreign steel. There is a minimal use of steel or iron allowed, and it is not to exceed 1/10 of 1%. Some people, when they're reading in there, sometimes they say 10%, but it's 1/10 of a percent. So 1/10 of a percent of the total contract cost, or $2,500, whichever is greater. So if you can justify and validate that you meet that criteria, the iron or steel can be incorporated into the project. Most of the time, people don't do the alternate bid provisions very often, and the minimal doesn't happen very often. So then the next step is you have to get a Buy America waiver. So Buy America waiver has to be submitted to our headquarters. So these are not even approved. These have to be approved up at our headquarters level. So you would submit that waiver through the division office. They would run it up to our headquarters where they make the determinations on Buy America. They actually put it out for public comment. It's quite a long process. So it's not just a matter of saying yes or no. It has to go out and get public comment. So oftentimes this might only happen once or twice a year when we're doing it. But as I mentioned, the current administration has said that we are not going to authorize any Buy America waivers. Now I do know that there's one from Alaska that's up there being reviewed, but there's no guarantee that it's going to get approved. So you can still submit them if you want. I'm just telling you that most likely they're not going to get approved. But basically what it does is Buy America, we go out and make sure, hey, is it in the public's best interest for us to use this domestic iron or this foreign iron or steel? And you have to get that waiver before you can actually do it. And it is a lengthy process, so you have to make sure you have enough time to get the approval. Okay, so now let's talk about supplies. Basically, supplies are, hey, if we're talking about equipment or things like that, we're going to say, hey, is this equipment or is this a supply? Like the computer example. If it's less than $5,000, then we're going to call it a supply. But supplies could also be just like your general supplies that you buy, paper, all those types of things. If you're going to use those on a federal project, most of the time supplies are not going to be directly charged to a federal project, because most of the time supplies are used on many different projects, and it's very hard to say, this box or pallet of paper that we just bought is going to be used on just this project. You really can't allocate those costs correctly by charging the 100% of that, all that paper to one project. So most of the time supplies are going to be in your indirect cost, but it is very possible, like with planning, where the work program activity, they could go out and buy some supplies just to support that activity and it would be okay. So you just have to document, does the activity or the project benefit 100% from the supplies that you're purchasing? If it does, then you can charge it directly to the project. If it benefits many different projects, then most likely you're either going to have to put it into your indirect cost allocation plan, or, and I use this as an extreme example, hey, we have this box of paper that's got 10,000 copies in it, and each piece of paper is valued at this much, and we can allocate those costs to all the different projects. But that's going to take you forever. It's going to be very burdensome, and I don't recommend doing that. So it's way better to just dump it in your indirect costs and bill it through your indirect cost pool. You guys don't have an indirect cost rate, so that's just going to be a state-funded item. Now let's talk about residual inventory. So let's use the computers again. We're going to go out, and I've seen this before with handheld diaries. So states want to go out and buy these handheld diaries. They're not $5,000 each, but let's say they want to go out and buy 10 or 15 of them, and they're $1,000 each. Now we're at like $15,000. So now they're still considered a supply, but now we have to track that aggregate value. So when you're done with those 10 or 12 items, you want to look at the total value of all of them together, and if it's less than $5,000, we don't care what you do with it. If the value is more than $5,000 and you're done with them, then you may have to pay us back. Yes? No, I would not do those on necessarily on a project, because if you put those handhelds, most of the time this is going to be via a indirect cost. Because if you buy a handheld diary for one project, you're most likely going to use that diary, that handheld, on many different other projects, right? It's not going to benefit just one project. It's going to benefit multiple projects. So you would probably not procure those and charge them directly to a project. Now, what I would recommend doing is allocating the cost to the project. So you don't have to have an indirect cost rate in order to allocate the cost. You could just come up with some sort of method to say, okay, we bought all these handhelds. They're going to last us for however many years, and we're going to just allocate these out over various different projects, and you could do it by district or by division if you wanted. But you would have to have some sort of allocation method, because you couldn't charge them just directly to one project, because they don't just benefit that project, they benefit a whole bunch of different projects. for SPR, for the handhelds. That's where I've seen people charge them. But still, if you're billing it to a work program, an annual work program, what is the benefit of that SPR activity to having those handhelds? They don't just support one activity, they support your entire program. So my recommendation is you have to have them allocated across all of your program, so the whole program gets a benefit and the whole program gets billed. If you just charge it to one SPR activity, then that's really defeating the purpose of allocation and showing cost benefit to where those, because how long do the handhelds last? I mean, they could last 3-4 years possibly. And you're going to use one handheld in one district or one division, you might use that on 10 or 15 projects. But we're only charging them to one activity in 1 year's SPR, and that wouldn't be allocable. It's called allocability. Okay, so just to remind you, on equipment, remember we said that the state gets to decide what your local governments are going to use for equipment. It's the same thing with procurement. So this was in our exceptions in 2 CFR 1201, but basically for procurement, it says in 2 CFR 200 that the states are going to follow your same procedures and policies that you use with your non-federal dollars. So basically we're just saying you have to have the same procurement procedures for your state program and your federal program, and you get to use whatever procedures that you have in place in the state. What 2 CFR 200 then says is that other non-federal entities must follow 2 CFR 200. But we have an exception that allows the state DOTs to determine what their local governments or their subrecipients are going to use. But it has to be still in line with 2 CFR 200. And then we're going to take a break here in a minute. I know I've been talking up here for a while.